Hello, it's a pretty lovely evening from here in Chile, and hope as always that each one of you are absolutely fine, and we on our part always pray to the Almighty to provide you with supreme amount of health. So on such note, we start today a chapter, as you can see flashing on your screens, India's 103, of course, business combination and corporate restructuring. Needless to add that it happens to be pretty heavy chapter, pretty formidable one, and quite lengthy at the same time, but very important from the examination point of view. Now, before we come directly to the provisions of India's 103, of course, which deals and talks a lot about what we call business combinations, even though the name of the chapter is business combination and corporate restructuring, but I will simply refer to it as business combination. So as I was just simply talking about this particular fact that India's 103 talks a lot about what we call business combination. But before we come over to that particular part, let me actually clarify some important what we call points so that later on you should not develop any sort of what we call confusions with respect to several other Indias, because otherwise it seems a very complex picture, because many among us do not know where to apply India's 110, where to apply India's 103, where to apply India's 27, where to apply India's 28. So all this confusion, first of all, let me actually erase out, as I told you before I come over to India's 103. Just pay attention, and if possible, pick up your pen and pencil too. We come straight to the business in today. Now, first of all, just wait. Let us say there is an entity by the name of E1. Name of the entity is E1. And this entity has invested in shares of E2 Limited. Correct? E1 has invested in shares of E2 Limited. First of all, you need to understand that the entity which invests, in this case E1 is investing some amount in the shares of E2 Limited. So from business terminology point of view, we may call E1 as an investor. E1 is investor, correct? E1 is the entity which is investing in the shares of E2 Limited. So E2 Limited, the company in which investment is done, is known as investee company, I'm simply starting from the scratches. So just pay attention. These things will hold you in a very good state. Correct? E1 is the investor, E2 is the investee company, and henceforth I am not going to tell you which is the investee company and which is the investor. You have to keep it in your mind and store it quite well. Now, when we say this entity is investing in the other entity, where we are investing in their shares, debentures, bonds, whatever it is, correct? Now suppose this particular entity has some share capital and I have invested in this particular entity, and my investment is, let us say, in between 1 to 19%. 1 to 19%, what does it mean? Whatever is the total share capital, let us say 100% is their total share capital, and I have purchased some shares. So my shareholding in this company, let us say 7%, 8%, 9%, up to 19%. So if an investor invests into some other entity and the stakes are in between 1 to 19%, in that case, it is considered as normal investment. In that case, it is considered as normal investment. Normal investment. If an entity invests in other entity, correct, and their stakes are in between 1 to 19% of the total share capital of that particular entity, then it will be considered as normal investment. Why I am saying it will be considered as normal investment? Because in this case, investor, E1 entity, will have to do the accounting as per Ind AS 109. Investor will do accounting as per Ind AS 109. This is important aspect which you need to understand. So investor will have to do the accounting for the investment which it has made in the other entity, and the accounting will be done as per Ind AS 109, and accounting will be done only in SFS. Only in SFS. What does it mean? Only in SFS. SFS means separate financial statement. Indirectly, what I am trying to actually pull into your mind is the fact that when we invest into some other entity and our investment are less than 20%, in that case, we will account our investment in a normal manner, and in a normal manner means we are going to do our accounting for our investment in other entity by applying the provisions of Ind AS 109. You need not require to at this particular moment bother about what Ind AS 109 states. Correct? Because that we will pick up when we will do what we call financial instrument, because under financial instruments we are going to study Ind AS 32, Ind AS 107 and Ind AS 109. However, at this particular point, you need to understand only one thing, that investor will have to do the accounting as per Ind AS 109, number one, and accounting will be done only in separate financial statement. In other words, in this case, investor need not require to prepare consolidated financial statement. In this case, there is no need to prepare CFS. This is the first vital point which you need to understand. Correct? Coming over to the second point. Now come to the second point. We presume now there is another entity. There is another entity now. This entity is E3. This time E3 is the investor and E3 invests in E4 Limited. E4 automatically will become investee company. Now, if our investment is in between 20% or more, 20% or more, but up to 50%, but up to 50%. Correct? If I invest into some other entity, and out of total share capital of that particular entity, let us say in my hands there are 21% share, 20% share, 20% share, 35%, even 50%, but not more. In between 20 to 50%, in that case, you must understand that this investee entity will be considered as an associate of investor. E4 will be considered as associate. It will be considered as an associate company of this investor. This time E3 is the investor company and E4, the investee company, will be considered as your associate. You saw earlier that when our investments are less than 20%, then we are not having any relationship with this particular entity, and in that case we are not preparing any consolidated financial statement. We will have to do the accounting only in separate financial statement. However, here what will happen? In this case, investor will have to prepare two financial statement. Investor will prepare two financial statement. He will have to prepare this time two financial statement, unlike the previous case, because this time we have a relationship. This entity will be considered as our associate, because when we acquire more than 20% stake but less than 50%, it gives us significant influence over the other entity. However, we are going to take up all these terms later on when we are going to take the chapter or standard on associate. Correct? Anyway, at this moment, you need to just keep in your mind that when our investments are in between 20% to 50%, then other entity is our associate entity. In that case, we have to means investor company will have to prepare two financial statement, one separate financial statement. Obviously, one will be separate financial statement, and besides, we will have to prepare in this case consolidated financial statement. We will have to prepare consolidated financial statement because this time we have significant influence in the other entity and we are supposed to prepare consolidated financial statement. But when we will prepare separate financial statement, when this investor will prepare the separate financial statement, wherein investor will only write its own assets and liabilities. However, we have made some investment in A4 Limited. So quite obviously we will have to present that investment. So when I say investor will have to prepare two financial statement, one is separate financial statement, another one is consolidated financial statement. What I'm trying to say is that actually how the investor is going to present the investment made in the associate in its separate financial statement. In that case, in the separate financial statement, investor will have to account the investment as per Ind AS 27. Ind AS 27. That means Ind AS 27 will now come into play. You saw earlier, when investor made the investment and the investment were less than 20%, only separate financial statements are needed, and in this separate financial statement we will account the investment in the light of Ind AS 109. But here we are getting some significant control, not control, but significant influence over the other entity. Other entity will become our associate. In this case, we will have to prepare two financial statements. One is separate financial statement, another one is consolidated financial statement. Important point is how we are going to present our investment which we have made in the associate. We will this time have to account our investment as per the provisions of Ind AS 27. Time and again I am telling, at this particular moment you need not require to bother about what Ind AS 27 states, what Ind AS 109 states, because ultimately our concentration area is Ind AS 103, so we are going to cover up provisions of Ind AS 103. But I just simply want to actually put into your mind some these basic points, because these points will help you later on, correct, to get away from the various other complexities. So Ind AS 27 now will come into play, and they will also have to prepare the investor will also have to prepare the consolidated financial statement. However, consolidated financial statement will be prepared as per Ind AS 28. As per Ind AS 28. Consolidated financial statement will be prepared as per Ind AS 28. When we will study Ind AS 28, over there we are going to study how the consolidated financial statements are prepared under Ind AS 28. Correct? These are very, very important points which you need to understand. So far so good. Now we come over to the next point. I will keep this sheet over there. These are basic points, but these are very important points, and it will definitely help you, as I told you, to get away with various complexities which most of us actually are always gripped up with. After this point number third. Now in point number third, what I write, let us say there is another entity. There is another entity, correct? And this is E5 Limited. E5 Limited has made some investment in equity shares or simply shares of, let us say, another entity E6. However, this time we have purchased some shares of this company, but we purchased shares in such terms that it gave us more than 50% of the stakes of this company. Let us say total number of shares of this company are 10,000. Out of that, if I am going to purchase 7,000 shares, then it will give me 70% stakes in this company, isn't it? So this time, let us say E5 Limited has made investment in E6 Limited, and investments are more than 50%. More than 50%. When we say more than 50%, that means whatever share capital is there, 100% share capital, out of that, more than 50% shares are in our hand. Quite obviously, when an entity invests into other entity, and its investments are more than 50% of the total stakes of this particular company, quite obviously that particular company will be under our control. So this time we may say that E5 is exercising control over what we call E6 Limited. So this time it will be considered that control has come to our hand. Number one. I have already told you we are investing company. I need not require to tell you we are investor company. This is investee company. I told you in the beginning itself, but besides that, this time this company will be our subsidiary company. Subsidiary company. It will be our subsidiary company. Correct? This will be our subsidiary company because we have acquired now control over this particular company. So this company will have to obey our instructions, obey our terms. So whatever guidance we are going to give to this particular company, that company will have to follow, simply because of the fact that we are holding more than 50% of the share capital of this particular company. So we may say control is in our hand. When we say control is in our hand, that means this particular entity, all the relevant activities are in our hands. Is it clear to you? So more or less, this company is almost like our company, but at the same time, remember one thing, that doesn't mean that this particular company has become our property. This company will function as a separate entity, but only thing is that this particular company will function under our directions, under our terms, under our what we call policies. That's the major point which you need to understand. Now in this case, investor will also be called as parent company or holding company. Investor will be known as parent or holding company. However, under Ind AS, we will use only term parent. Correct? So this time we acquired more than 50% share of this particular company. Control has come to us. Now this time it will be termed as business acquisition, because we have acquired this particular company in substance. Correct? Because this company is more or less our company, even though it will keep on functioning as a separate unit, no question about that. But at the same time, in substance, if in reality, actually, if we will look into, we'll find that this company as if almost our company, because this particular company is running as per our direction, our policies. So when we acquire more than 50% shares in a particular entity, the control will come to us and it will be termed as business acquisition. It will be termed as business acquisition. Is it clear to you? Now in this case, pay attention, very, very important this time. Because again, there is a relationship between the investor and investee. The relationship is much more powerful than the previous case. In the previous one, there was relationship between the investor and investee is of investor and associate. But now there is a relationship between these two entities of parent and what we call subsidiary company. So now what will happen? In this case, parent limited will have to prepare two financial statements. Parent limited will have to prepare two financial statements. I need not require to tell you financial statements. Parent will have to prepare two financial statements. One will be separate financial statement. One separate financial statement. And separate financial statement will always be prepared as per Ind AS 27. That means when parent limited will prepare or keep track of only its own assets and liability in the separate financial statement. So sometimes we also call it a standalone, what we call statement. So separate financial statement wherein we are going to put up our assets and liabilities. Since we have made investments in this particular company, how we should present that investment, that will be as per Ind AS 27. Ind AS 27. Correct? And besides that, now I will have to prepare consolidated financial statement. Consolidated financial statement. Very important now. And most of us are unaware of all these points. You are few among those now who will know this tricky point. Now I will have to, now I means this company E5 Limited will have to prepare consolidated financial statement. Logically, in practical life, when I take over another entity, and when we say that we are taking over another entity, that doesn't mean that we are completely taking over. That means we are acquiring control over the other entity. When we acquire control over the entity, that automatically means actually directly or indirectly we have taken over that particular entity. It is quite simple. So in that case, E5 Limited will have to prepare consolidated financial statement on the date of acquisition. On the date of acquisition or Date of control, sometime we say. Date of acquisition. Date of acquisition means the date on which control actually has been acquired by you. You are the acquirer company. You are the acquirer company. Correct? Now you will have to prepare consolidated financial statement on the date of acquisition. Now you need to understand. On this date, when you are going to prepare the consolidated financial statement, you will prepare it as per Ind AS 103. Many students and many others are having this confusion. Sir, when we talk about consolidation, people say that Ind AS 110 is related with consolidation. Some people say Ind AS 103 is also related with consolidation. Now you must understand. When we are going to consolidate means when we are going to prepare the consolidated financial statement on the date of control. On that date, I will have to apply the provisions of Ind AS 103, and at the year end or subsequently, after this date, whenever I am going to prepare consolidated financial statement, at the end of financial year, whenever our accounting year will end, correct? In that case, again I will have to prepare the consolidated financial statement, correct, on the reporting date. On the reporting date, when we will prepare consolidated financial statement, in that case, consolidated financial statement shall be prepared as per Ind AS 110. As per Ind AS 110. This is the significant point which you need to understand. As I told you, many among us are under confusion when to apply Ind AS 110 and when to apply Ind AS 103, because directly or indirectly both talk about consolidation, and that is why this confusion has gripped many, but very few are aware of the reality. So when we acquire another entity, we acquire the control of the other entity, correct? That becomes a case of business acquisition. In that case, we are parent company, holding company, or acquirer company, while other company is subsidiary company or acquiree company. We are acquirer and other company is acquiree company. In that case, acquirer company or the parent company will have to prepare financial statement. Quite obviously, it will have to prepare the separate financial statement, and besides that, it will have to prepare consolidated financial statement. But how the consolidated financial statements are prepared on the first day, when I say on the first day, that means on the date of acquisition, this particular chapter deals with this particular point. Is it clear to you? Ind AS 103. That is the theme, that is the crux, that is the focal point of this particular chapter. While when at the year end or on the reporting date, we will prepare consolidated financial statement, that we are going to study under Ind AS 110, correct? So that is the point, and that is also the reason why it is always better to do Ind AS 103 first and then follow it up with Ind AS 110. So these are the points which you need to know, and that will hold you in a very, very good state. Is it clear to you or not? Besides, although the main point which I just wanted to tell, I have already told you, but besides that, because now I have started this topic, let me finish it also. Besides, there could be some other situation. For example, let us say, what should I say? Let us say there are two entities, E1 and E2, correct? There are two entities, E1 and E2. Both these entities enter into a joint arrangement. Joint arrangement. Both these entities enter into a joint arrangement. And joint arrangement is in the form of joint operation, correct? Joint operation. Let us say both these entities have decided that we are going to construct a pipeline. Let us say both these industries, both these entities are in oil industry, let us say, correct? And let us say they are facing a problem to ship their oil to Bangladesh. So they enter into a mutual agreement. Okay, why not actually let us build, correct, with common efforts a pipeline, and we will use that pipeline to supply our oil to the other countries, in this case Bangladesh. Is it clear to you? So that is nothing but a joint venture. That means in this case both these entities are combining to start some operation. It is known as joint venture. It is known as joint operation, and joint operation is one form of joint arrangement. First of all, you need to understand this, correct? So in this company, both E1 and E2 will have to prepare SFS, separate financial statement. E1 will also prepare separate financial statement, and E2 will also prepare separate financial statement. That means they need not require to prepare consolidated financial statement, and separate financial statement will be prepared as per Ind AS 111. In this case, Ind AS 111 will come into play, because Ind AS 111 deals with all these facets of joint arrangement. Joint arrangement basically of two types. When we are going to study this particular standard, then we will talk a lot about that. One is joint operation. You understand actually what exactly the joint operation is. In this case, simply two or more than two entities will combine into, and they will start what we call a joint operation, and they will share the results of that operation. That's all. However, there could be another form of joint venture. I will keep this sheet over here. There is another form. Let us say fifth point. In this case, let us say there are entity E1 and E2. E1 and E2 this time decided to enter into a venture. To enter into a venture, what does it mean to enter into a venture? Correct? That means, let us say they have decided to open a new company. This new company will be known as venture. This new company is nothing but joint venture, because they have jointly started this particular venture or business. Correct? And this venture will function almost like a company. So in this case, E1 and E2 will be known as investor or venturer, as you may call it. But the point here is that it is also a form of joint arrangement. But this time it is known as joint venture. As I told you, it is known as joint venture. In the earlier case, E1 and E2 actually, they simply combined with each other to start and they constructed a pipeline, correct? But here, both these companies enter into an agreement, and they combinedly what we call are opening a new venture. So in the new venture, obviously they are going to invest something, and obviously whatever results will be there, they are going to share it. So joint venture it is. In this case, both E1 and E2, correct, will have to prepare separate financial statement. Correct? Separate financial statement. I have already told you separate financial statement shall be prepared as per Ind AS 27. And besides that, they will have to prepare consolidated financial statement. But consolidated financial statement will be prepared as per Ind AS 28. Ind AS 28. Are you getting my point or not? This time E1 is venturer, and this one will be considered as its joint venture. E2 is venturer. This will be considered as joint venture of this entity. Is it clear to you? You must have noticed one thing. Consolidated financial statement can be prepared under Ind AS 103, can be prepared under Ind AS 110, can be prepared under Ind AS 28. Generally, consolidated financial statement will be prepared under Ind AS 28 when we do not have the full control over the other entity. Consolidated financial statement as per Ind AS 110 will be prepared when we have full control over the other entity, but we are going to prepare it on the reporting date. When we are preparing it on the reporting date, then only Ind AS 110 will come into play. While Ind AS 103 is quite vital in the sense, because here again we are having control of the other enterprise. But the day on which we acquire control, on that date, We are going to prepare a consolidated financial statement. Then Ind AS 103 will come into play. So these are the things which, as a professional student, you need to know before you delve into what we call business combination. Now we come over to the next part, correct? In this case, now in the next part, just wait. Some important points I will also write before we move further, so that you shouldn't skip them. If investments are more than 50%, in that case, I have already told you, in fact, this point, investor is known as parent or acquirer company, or acquirer company. Is it clear to you? Note number 2. Investor, its subsidiaries, other entity could be our subsidiary only when we have more than 50% stake in it. Investor, its subsidiary or associate, or joint arrangement. We were talking about joint arrangement earlier. So if I am an investor and I have a subsidiary or an associate or a joint arrangement, in that case, combinedly, all these points combinedly will be known as group. Investor, its subsidiary or associate or joint arrangement are combinedly known as group. Combinedly. Known as group. Correct? Third, accounting of investments, in subsidiary, associate, joint venture, in SFS shall be done as per Ind AS 27. We have already talked about this. So if I have a subsidiary or I have a associate or I have a joint venture, in that case I am supposed to prepare what we call separate financial statement. In that case, whatever investment I have made, I will account those investments as per Ind AS 27. Correct? We will see later on. Actually, just for the time being, actually I am telling you what Ind AS 27 states. Ind AS 27 simply states that investments in subsidiary, associate, joint venture, correct, can be at cost, can be represented at cost. Suppose I have acquired 10,000 shares of rupees 10 each, but I paid 1,50,000. So I can reflect the investment at rupees 1,50,000. So I can reflect the investment at cost, or I can reflect the investment, or Ind AS 27 states that you can reflect your investment at cost, or as per Ind AS 109. Ind AS 27 states that you can reflect the investment either at cost or as per the what we call guidelines of Ind AS 109. And Ind AS 109 simply states that you can represent your investment at fair value. I do not want to confuse you at this particular moment. Actually, Ind AS 109 states that you can classify your investment at fair value through profit and loss account or fair value through OCI. But if I'm going to use these terms at this particular point, you won't be able to comprehend anything. So for simplicity, I have told you that Ind AS 109 simply tells that you can represent your investment at fair value. So what my point is, try to understand where is the rough sheet. Suppose I have purchased 10,000 shares of rupees 10 each. This is the nominal value, 1 lakh. And let us say I have purchased this share for rupees at the rate of 15. So this is my cost. So I can reflect my investment either at cost or at fair value. Let us say fair value is 1,75,000. So I can reflect it at 1,75,000. Are you getting my point or not? So that is the point here. So Ind AS 27 states that you can reflect in your separate financial statement your investment either at cost or as per the provisions of Ind AS 109. And Ind AS 109 simply states that you can reflect your investment at fair value, at fair value. Now, further, when we make the investment in other entity, quite obviously we are bound to get some return out of it. We may receive dividend or interest in it. So we need to understand with it also any dividend or interest on such investments shall be recognized or should be recognized in P&L. Should be recognized in P&L. Remember one thing, this point is with respect to separate financial statement because Ind AS 27 deals with separate financial statement. So Ind AS 27 states that when you have made your investment in subsidiary, joint venture or joint arrangement or joint operation, in that case you will account your investment either at cost or at 100 or what we call as per Ind AS 109, that means at fair value. Further, whatever dividend or interest income which you are going to receive on such investment, you are going to reflect that in your P&L. It is as simple as that. These are the provisions of Ind AS 27. Now, after having a look over these basic points, and honestly speaking, these are quite vital. Now we move over to the main area. Let's come over to business combination. So what is business combination? First of all, let's have an idea regarding that. So let's understand it. Meaning. Meaning of business combination. I have already told you business combination will occur only when you will get control over the other entity. Correct? So, business combination occurs when a company acquires control over business of other entity, business of other entity. Logically, it means, just wait for a while before I move further, let me clarify this particular point. Suppose E1 takes over E2. When I say takes over, I mean to say E1 is taking control of E1, and you know control can be acquired by investing in this entity, correct? And our investment is more than 50%. So control will come to us. But the point is that when we take over the other entity, it is very important that other entity must meet the definition of business. It is very important that other entity must meet the definition of business. If I am taking control of other entity and other entity is not meeting the definition of business, in that case, it will not be called as business combination, and quite obviously in that particular case, Ind AS 103 will not come into play. That means Ind AS 103 will come into play only when you are taking control over the other entity. Indirectly, it means you are taking control over the business of the other entity. That means other entity must satisfy the what we call term business. What we mean by business, then it is also very important. So control occurs when a company acquires control over business of the other entity. So it is very important to understand business. Business means standard defines business as a set of integrated activity. Integrated. Business means integrated set of activities. Integrated set of activities. Integrated set of activities having following three elements. So standard says that business basically means integrated set of what we call activities, and so basically these integrated activities are nothing but set of three elements. What are those three elements? One is known as input, other one is known as processes, and third one is known as output. What is input? When I take over the business, when I say that other entity is a business, what does it mean? That means when I'm taking over the other entity has got some resources, such resources and assets or the manpower, correct? So inputs basically means like resources, that is assets required to generate output. Example, for example, various property, plant and equipments, various intangible assets, manpower, all these are examples of inputs, correct? Then processes simply means techniques, technical know-how, expertise actually, correct? So processes simply refers to techniques, technical know-how, that can be used on inputs to generate output, correct? So when we say processes, that means we are talking about techniques, we are talking about technologies, know-how, We are talking about management process or simply management. That is what we mean by process. Is it clear to you? And many people actually don't able to understand, or not able to understand, should I say, the real meaning of output in the context of this term business. Of course, business is a set of activities and it has got three elements as we have seen. One is input, another one is process, third one is output. Output doesn't mean that these things should be capable of producing the output. That means there must be ability. If I am going to integrate input and output, input and process, that means I should be able to produce what we call some output. And output basically refers to your production units or dividend or profits, that's all. So output, it means ability to generate revenue by using input and processes. Try to understand this way around. Suppose in the market there is another entity by the name of E2 and I am the investor. And let us say more than 50% stakes, I am ready to invest in this particular entity. However, this entity is quite new in the trade. This entity is quite new in the trade. And this entity has, let us say, developed a patent. Correct? Developed a patent, high quality technology they have developed. And this entity has already entered into some negotiations with the potential customer to sell or to let out these patents on franchising. And if I am taking over this particular entity, even though at this particular moment, let us say this entity is not generating any revenue, but that doesn't mean that it is not a business. This entity still will be considered business, because if I am going to take over its patents, that means all its inputs and processes, then I will have the ability to generate the revenue, because in that case I will acquire the patents and I can easily what we call contact those clients with whom already they are entering into, and in that case I will be able to generate the revenue. So even though entity might not be producing output at this particular moment, but if we have the ability, that means by combining the processes with the input, if we are able to produce the output or generate the output, that will be considered as part that this entity is meeting the definition of business. So very important is that when we say we are acquiring the control of the other entity, that means basically we are acquiring the control over the business of the other entity. Ind AS 103 will come into play only when one entity acquires another entity. Acquires means acquiring the control of the other entity, and other entity must meet the definition of business, and business simply means resources and what we call processes which can be combined with each other to generate some revenue. That is important. Now, one more point is, I told you business combination occurs when company acquires control over the business of other entity. Control over the other entity. See it here. Control can be acquired. Control A can be acquired by acquiring more than 50% equity shares. So if I will get more than 50% of the equity shares of the other entity, quite obviously control will be in my hands. So this is one way of getting the control. We call it majority stakes. Is it clear to you? However, in rare cases, control can also be acquired B or by acquiring power to constitute or compose board of directors. Board of directors of other entity. Other entity means acquiring entity. For example, what I want to say actually, suppose this is acquirer entity, let us say. This entity is acquiring this entity. And let us say we have made an investment of only 10%. Logically, in this case, it cannot be construed that we have acquired the control over this particular entity, is it? It is not possible. 10% will not fetch us any control. However, let us say there is an agreement between this entity and us that this entity will have the power to compose the board of director or to constitute the board of director. To compose or constitute the board of director means we shall have the ability and power to appoint or to discard or to set the remuneration of the board of directors. So in that case, it is said that we are having the what we call power to compose the board of director. So sometime it happens in practical life, but even in this case, I will have to make some investment. Suppose my investment is 10%, 15%, 30%. Less than 50%. But if I have got this particular sort of agreement, so even in that case, it will be said that control is in my hand. Then the next point is or by acquiring power to direct all relevant activities. So sometime we may get power. Actually, in these two cases, power will accrue to us only through some agreements. Sometimes there is an agreement between the acquirer and acquiree. So even though if my investment will be less than 50%, but if there are some agreements like this, so in that case, acquirer will be in the driver's seat and it will be considered as if acquirer is having the control of the other entity. So logically, control is acquired through investment. And generally, if your investment is more than 50%, easily you will have the control. Sometimes your investment is less than 50%, but in that case, there may be an agreement like that you will have the what we call right to compose the board of director, or you will have the right and the power to direct the relevant activities. So in such cases, it will be said and it will be construed as if the control is in our hand. Is it clear to you? Importantly, this is one way of getting the control. Remember, in this case, in all these cases, we have to make some investments. We have to invest something in all these cases. Whether our investment is more than 50%, 10%, 20%, but some investment we will have to make. However, there is another situation. Control can also be acquired. Control can also be acquired by acquiring net assets of the other entity. This time we are not making any investment. Net assets of acquiring company. This is very important. When you get the net assets, all the net assets of the other entity, quite obviously now other entity will become your entity, and in this case the other entity will stop what we call functioning. However, when you get the control in this manner through some investment, other entity will continue to operate. That's a different matter. It will operate under your what we call wings, under your directions. However, when you get the control, or when you acquire the other entity by purchasing its net assets, automatically in that case, the existence of other entity will definitely be no more. Other entity will cease to operate. It will stop operating the things. Control can also be acquired by acquiring net assets of the other entity, and in this case, other entity, in this case, acquiring entity, in this case, acquiring entity shall stop operating, So in this case, operating company will cease to operate. It is very important. It is clear to you or not? Also, in this case, acquirer company will account business combination, because we have acquired their business, so it's a case of business combination. Acquirer will account business combination in separate financial statement only as per Ind AS 103, as in this case no CFS is required. I told you, generally when we acquire the other entity, we are supposed to prepare what we call consolidated financial statement. But this is the case wherein without making any investment, in fact, this time you are purchasing the business of the other entity. And this time the existence of the other entity is no more. So quite obviously you cannot prepare consolidated financial statement. So whatever accounting you will do in your separate financial statement. However, such cases are quite rare. In practical life, generally the control is required, and control generally is required through investments by investing more than 50%. So in that case, existence of the other company will be there. So you will have to prepare consolidated financial statement on the date of acquisition. So significantly, this particular standard basically talks about how the accounting will be done in the books of acquirer on the date when you get the control of the other entity. Is it clear to you or not? So now we come to the main area of this particular topic after having a look over the initial facets, correct? So now I write here accounting for business combinations. Accounting for business combination. Ind AS 103 states that in order to account, we will have to apply acquisition method, as most of you are quite familiar or might be familiar with this, correct? Ind AS 103 provides accounting for business combination on the date of acquisition. On the date of acquisition, so often I am going to use this word, so I will write DOA, date of acquisition. So on the date of acquisition, how the acquirer is going to do the accounting, that's the actually main theme. So following steps are required. What are those steps? Following steps are required. Following steps are required. Presume you are the acquirer and you have got the control over other entity, correct? Let us say you have invested in other entity and your investment is in the vicinity of 70%, 80%, that is more than 50%. So obviously you have acquired the control. So first thing which you are supposed to do is step number 1. As per this particular standard, the first thing which you are supposed to do is step number 1, identifying the acquirer company. Now you may wonder actually why this step has been laid out by this particular standard. Identifying the acquirer. Quite obviously, acquirer company is the one which obtains the control of the other entity, no doubt about it. And generally, let me actually make it this. Sometime what happens, let us say there is an entity, A Limited acquires control. Let us say invest in 55% of this entity. This entity has invested in 55% share capital of this entity. So we have the majority stake. We are acquirer company. When we'll make the investment in other entity, quite obviously we are getting control of the other entity. So we are known as acquirer entity, and this entity is known as acquiree entity, without any doubt. However, we are legal acquirer. Legal acquirer means in the eyes of the law, we are the acquirer. And B is the legal acquiree. No doubt about it. 99.99% the legal acquirer will remain the accounting acquirer. No doubt about that. 99.99%. The entity which is taking over the other entity, the acquirer company, generally is also known as accounting acquirer. Actually, as per this particular step, when we say identifying the acquirer, it basically means for the purpose of accounting, who is the acquirer? It means sometime on some rare situation, it may happen that in spite of the fact that someone is the legal acquirer, but for the purpose of accounting, other entity may come into play. Are you getting my point or not? For example, here A Limited has taken over B Limited. So A is legal acquirer, B is legal acquiree. That means from the legal provisions, A will remain acquirer, legal acquirer, and B will remain legal acquiree. However, accounting acquirer, generally accounting acquirer means the entity who has got the control. So in this case, A has invested in more than 50% stakes of B Limited. Quite obviously, in this case, A Limited is having the control, so A will also be the accounting acquirer. That is the reason why I am saying 99.99% legal acquirer will remain accounting acquirer. However, sometime it happens that legal acquiree may become accounting acquirer. For example, let us say A Limited takes over B Limited, correct? However, there is an agreement between A and B Limited that we will have the control. So here in this case, because A is taking over the B Limited, technically A is the legal acquirer and B is the legal acquiree. But for the purpose of the accounting, B will be considered as legal acquirer because control is in the hands of B. That is what we mean by accounting acquirer. So identifying the acquirer, basically, what does it mean? First of all, identifying the acquirer. Acquirer is the company acquirer is the company whom obtains the control over the business of acquiring company. So suppose in this case company A acquires company B. As I told you, company A will be considered as legal acquirer. And company B will be considered as legal acquiree. So basically identifying the acquirer means identifying the acquirer for the purpose of accounting. Identifying the acquirer means identifying the acquirer for the purpose of accounting. For the purpose of accounting. "99.99% legal acquirer remains the accounting acquirer. However, in rare cases, legal acquirer could also be the accounting acquirer. And if it happens, if legal acquirer becomes the accounting acquirer, that is known as a case of reverse acquisition, regarding which we are going to study later on. Although most of time legal acquirer shall remain accounting acquirer, yet sometimes legal acquirer too could be accounting acquirer. So it is a possibility. Could be accounting acquirer. When legal acquirer becomes accounting acquirer, then it is known as a case of reverse acquisition, reverse acquisition, reverse acquisition, then it is known as a case of reverse acquisition. Is it clear to you or not? So these are the things which you need to know, but lots of things we still have to take into account. So this was our first step. Second step is now, second step, determining the date of acquisition. Of course, this is very, very vital. Date of acquisition. So generally the date of acquisition is the one in which actually acquired company obtains the control over the acquiring company. No doubt about that. And most of the time it is given in the question itself, so we do not confront much problem in it. Date on which acquirer company date on which acquirer company obtains control over acquiring company. But if any approval is needed or required from government, then date of approval by the government shall be considered as date of acquisition. So this is quite vital step, because on the date of acquisition ultimately we will have to do the accounting. The next step is third step, determination of purchase consideration. Of course it will be given in the question. Determination of purchase consideration. How much money you are going to pay to the acquiree. Correct? The consideration which your company will give to the acquiring company, you have to determine that. Honestly speaking, in 99.99% it will always be given in the question. However, some concept based question could be asked for with respect to determination of purchase consideration, some small question of 3-4 marks. So we have kept a separate section also for that, wherein we have included only questions on computation of purchase consideration. Otherwise, in longer questions, purchase consideration will always be given. Correct? Determination of purchase consideration. Generally, amount of consideration shall be given however it can be computed as follows. So, in order to compute the purchase consideration, all we have to do is to add, if we are transferring any cash, fair value of any asset, because purchase consideration can be given in any form. If you have given any asset, you will take the fair value of equity shares, debentures. So whatever you have given, equity shares or debentures, you will simply what we call take their fair value. Similarly, present value of deferred consideration. We will talk about it, but we have kept a separate section regarding deferred consideration. When I will take that topic, I will explain deferred consideration. Similarly, fair value of contingent liability. We will explain all these points because we have kept separate sections for deferred consideration, contingent liability, etc. So you need not require to bother about that. The third point is what we call computation of purchase consideration, and purchase consideration will be given to you even if it is not given. In the longer question, it will always be given, honestly speaking. In conceptual question, smaller questions, they may ask you to compute the purchase consideration. So it is not a tough task. That we will explain when we are going to take up what we call this particular topic. Correct? Now the next step, fourth step, is now you have decided you have determined who is the acquirer, number one. You have also determined that what is the date of acquisition. You have concluded at what amount of consideration you are going to pay to the acquiree. Now, quite obviously, the next step is identifying the net assets which you are going to take over of the acquiree. Identifying the net assets taken over of acquiring by acquirer. And here you need a bit of what we call bit of caution, because sometime otherwise we may commit in understanding this particular step. Anyway, at this moment I am going to hold down this particular lecture and we'll continue in the next session. We'll come up with many more things.